It's day 2 of the FM visit in Singapore, and frankly, the FM's visit couldn't have come at a better time. Everyone is curious to get a deeper understanding of the India story, and the curiosity levels in general are extremely high around when the economy will really revive. Whatever is happening to the eastern and the western part of the world is certainly helping a market like India. A, domestic institutional investors are back. B, directionally the trajectory of the economy clearly is headed higher in the right direction because interest rates are likely to come down and earnings are likely to pick up. So the pitch for India's story couldn't have been better given what is happening in the world.
Well, it's obvious that there will be concerns of this kind because you have global challenges. You have a challenge of the global economy having slowed down a little. You have challenges with regard to the uncertainty over the interest rates in US. You have challenges about what's happened recently in China. But then our effort has to be, as far as India is concerned, to make India, to the extent it is possible, resilient to these kind of challenges. And therefore that can only happen if our economy is on very sound footing. And therefore the concentration on the real economy and the parameters of that real economy. That's what we are trying to do.
You always maintain that rupee has to be a currency which is determined by market forces. Reserve Bank of India should not intervene. But at a time globally when every central bank or banker, they want their currency to remain weak so that they can gain export edge, what should RBI do? How should you do the balancing act?
Well, I think the RBI knows the range in which the rupee functions. And therefore, the RBI can't really interfere on a day-to-day basis as far as the rupee is concerned. As long as it is range-bound, I think that's a fair situation, and the RBI has been handling that situation.
The other obvious question has to be about rate cut. And now that inflation has got crushed, globally commodity prices have come down, is there need of the hour not for 25 but for at least 50 bips now?
Well, that's a decision the Reserve Bank will have to take. And I think when the Reserve Bank, as of today, has the full authority to decide this, we must learn to trust the Reserve Bank. And therefore, the bank has a history of being a very professional institution which factors in all these concerns. Everybody would like a rate cut. But the fact is that the authority to do it is the Reserve Bank. And I'm sure that they are conscious of the situation.
One concern about India seems to be that even though government spending has gone up in key sectors like railways, infrastructure, the investment cycle really has not picked up. The core data is not really indicating that the acceleration in the economy is there.
Public spending has increased, FDI has increased, private domestic investment has to increase. And therefore, the last few years have resulted in a lot of stress on the private sector itself. And I'm sure when a combination of FDI and public investment pushes the investment cycle up, performance parameters of private sector are also going to improve.
GST is the other common question I'm sure you will be asked here in Singapore and again in Hong Kong. If GST sails through on the floor of Parliament in December, are you confident of rolling it out?
No, I'm certainly confident of rolling it out. Depending on when GST gets cleared by Parliament, we'll have to determine the date. And you must always bear in mind that GST is not a tax which has to be introduced only on the 1st of April or not at all. It's a tax which can be introduced on any day.
So how much could be the time gap between once it's cleared on the floor of the Parliament versus the actual implementation?
You see, after it's cleared by the Rajya Sabha, it has to be cleared by 50% of the states, which I don't see much of a difficulty. Then there have to be 3 supporting legislations, 2 of which have to be passed by Parliament. But those legislations only require an lower house approval. So that should not be much of a difficulty. And then the states have to pass their own state GST laws.
Are you worried about NPAs in the PSU banks? I know some measures have been taken. Some of them are cultural measures which you've announced in the Indradhanush scheme. But banks have a large lending issue. The culture is a problem and the exposure to steel.
I think most important, the sectors which have resulted in the NPAs have to be addressed. And now we are also separately addressing each one of those sectors.
What would be your broad pitch to institutional investors you would be interacting with?
I think India needs a lot of investment, and India is one of the best investment destinations. That's the approach we have at the moment.
Are you excited about what is happening to financial savings? The Indian average investor is back. Mutual funds are now getting inflows on a daily basis. This time, even though foreigners were selling, domestic investors were buying. I mean, that's very, very heartening.
Well, even in the PSU disinvestments which we've had in the last 1.25 year, the private investors have broadly come in a big way. And therefore, that activity again is starting in the market.
Well, global investors in this part of the world are clearly excited, and I spoke to a bunch of them, starting from Akash Prakash to Clive McDonald. They are of the view that India is a resilient story, but in the short term, the economic acceleration is not on expected line.
The asset class has done very poorly. People are very worried about China, people are very worried about Brazil. The strong dollar, weak commodity is well known. So I think the emerging market asset class is challenged. Within that, I think India people are more positive, obviously, which shows in the ownership. I mean, I've been saying for some time that India is a favorite market right now, over-owned to a certain extent in terms of relative weightages. So I think people still see India as a safe haven. So the fact that our weightages are already so high within emerging market portfolios indicates that we are standing out already. And that's why India is an all-time relative high weightage for investors compared to history. So I think that the problem in India, I think, is that this is well understood now. That that the environment is actually supportive of India. So I think for us to have a next leg of movement up, it really is linked to corporate earnings now. I think the one disappointment in India has been the corporate earnings. Corporate earnings have been weaker than most people would have expected. There's still negative earning revisions. I think hopefully we're near the end of that. I think probably maybe another quarter of negative revisions, but after that it should stabilize. So I think for India to break out of this range on the way up, I think we'll need to see delivery on the earnings side.
I understand the historical averages, that earnings are below historical averages, they have to come back. It's the natural course correction.
Correct.
But earnings are not coming back. What is pegging us back?
Well, I think it's a combination of two, three things. I mean, one, of course, is that, that I think there is a lot of excess slack capacity in the system. So, companies don't have pricing power. Right? When you see a big crack in commodities like you've seen today, the companies which are commodity producers take it straight on the chin, right? Immediately their earnings go down because their selling prices immediately collapsed. While companies which have the benefits of the falling input prices, it tends to take a longer. There's more of a lag of that coming through the P&L account. So partly also you're seeing you're seeing a front end loaded negative, which is all the people producing commodities or having commodity inventories have taken the hit immediately, while the people who consume commodities, who will get the benefit of this, it's taking longer for that to reflect in either through the supply chain, or they have inventories, or they're taking, or they've not taken, they've already dropped the prices, they're not taking it up, so stuff like that. So I think it's a combination of weak top line growth, the fact that the losses are front end loaded among the commodity producers and you're not seeing the benefits yet, plus the fact that there's negative operating leverage and capacity utilization is much lower than people think.
According to you, the bull market is not over. This is a bull market correction. It is looking very ugly on the paper. It could be 10-12% for indices, 25-30% for mid-cap stocks. But from a 2-year time frame, 3-year time frame, this is time to put money to work.
I think so. I think that you should be sensible on pricing. I mean, I think that there was a bit of a overvaluation zone in mid-cap specifically. A lot of mid-caps, I think, had gone to really high valuations. That's correcting, which I think is a good thing. But I firmly believe that, as you said, and as I wrote, that this is a pause which refreshes. This is not the end of the bull market, in my opinion, unless you fundamentally, as I said, our thinking is based on 3 pillars, right, or 4 pillars, right? One is that we think economic growth will accelerate in the next 2 to 3 years. We're growing at 7.5% now, it'll be over 8. We do believe that inflation and interest rates are structurally coming down by 150 to 200 basis points further. So if Mr. Rajan has to deliver 4% inflation in 2 years' time, that means he's going to have a repo rate of 5.5. There will be there is a long-term secular asset allocation shift away from physical assets like gold and property into financial assets, which is visible. Which I think we're early stages of that move, and that will give you a constant bid in India to financial assets because the domestics will keep coming in.
Look at what happens on the political scene, on the economical scene, and frankly, no matter how much you make of the numbers, whether it's actually a 7% in a new series or a bit lower, and that kind of economic momentum, along with very benign inflation, you don't have that in too many places, really both of them. And a government that, we can argue about the speed, but I think even some of the smaller measures, PSU bank recapitalization, taking maybe some of the NPLs out, low increases of minimum support prices. I mean, all these measures, or many of these measures, are perhaps not big bang, but also not very populist like that. But the other side of India, of course, is the earnings growth generation. And that is something I think many portfolio managers on the EM side miss a bit. That has always been very strong and remains very strong. And if we get hit and if the rupee should become a bit weaker, you have so many exporters listed in India that actually helps them. So I'm not particularly worried about the country.
But 50% of the earnings for Nifty 50, the benchmark index, they are largely global in nature. It's IT, pharma, some exporters. If world contracts further, could that have impact on IT sector or a pharmaceutical sector?
I would personally see the impact a bit more on the IT sector. That seems to be more correlated with the global scene, if you will. Whereas I see, especially for the Indian pharma, in many countries, market share potential. Also in the US, you can probably argue that the whole generics or move to generics also on the American side is starting to flatten out a bit, but within it I think there is a lot of share to be gained for the Indian pharma vendors. So between the two, if you ask me, my favorites would be the farmers right now.
6 months from now, if we are looking at emerging markets, do you think the sell-off could become rather disorderly because China has just started slowing down, outflows have just started in the emerging market funds, or you think the world will be a better place and markets would have digested this problem called China?
There's two things. One is arguably the nervousness which you tend to have around Fed hikes, or the first Fed hike, which incidentally, we checked it over the last couple of cycles, oftentimes actually subsides once the Fed hike has actually happened.
5 out of 6 times the markets have gone up after the Fed hike.
That's exactly right, whether that's Asia or whether that's EM in general. So I would imagine that anyone who is concerned about the effects of a Fed hike has already more or less positioned for them, because we do know, whether that's September or December, but we do know they are likely to come.
So final question, the bull market in India is intact?
I think the prospects of India are very much intact for a couple of reasons. It is sitting in the sweet spot right now. So macroeconomically, you have an acceleration, or will get an acceleration on the GDP side, but not too fast. And that's important because you still want the potential for the RBI and Mr. Rajan to give us a few more rate cuts. And I think there will be multiple if you look maybe 12 months out. Then we have the reform side. And as I mentioned, yes, 2 of the big ones, they look a bit stalled, but there are still a couple of smaller ones where they can earn some or harvest some low-hanging fruit. And I think that will tide them over, because these measures are also quite important.
I think that we've got a window of opportunity. We saw some significant declines over the summer months in Asia and of course in South America and Brazil, Mexico as well. And now we're seeing a little bit of a return in risk appetite, and the absence of a Fed rate hike is fulfilling that, is helping further. But it doesn't change the overall backdrop. And the overall backdrop for emerging markets continues to be very, very challenging.
Emerging markets, they account for nearly 70% of the global growth. Within that, China approximately is 41 to 42%, depending on the number and the analysis or the analyst you follow. That 70% is under threat, and that 40%, which is China, is slowing down. We could be staring at a completely different world going forward. Could that lead to a serious adjustment in equities?
I think there is a real concern that we are going to experience a growth recession in emerging markets. And that is leading to investors to reassess their position. And we have seen continual outflows from emerging markets. I would expect this week we'll have seen inflows as a little bit of risk appetite has come back. But as I say, I think that's somewhat more cyclical. The key concern is this growth recession that we may already be underway. And that is serving to undermine investor risk appetite. And we've seen over time a withdrawal of funds from the emerging universe.
The finance minister, the Indian finance minister, is on a roadshow. And the idea here is to really talk about the India story. You've been a big fan of the India positioning, given what is happening to other emerging markets. India has been a resilient market. It has fallen less. Do you think this outperformance is here to stay?
I think that optimism towards India centers on the fact that it has a lower exposure to the developed world, specifically Europe and the US. And at a time when growth there has been less than anticipated, markets that are not leveraged to that growth are beneficiaries, and I think India's been a beneficiary of that. Going forward, I think that there's a lot of talk of rate cuts in India, and I think similar to the Fed, there is a window of opportunity with which the Indian finance minister could cut rates, and likewise there's a window of opportunity for the Fed to raise rates. But the risk is that those windows could close. Specifically, inflation via El Nino could kick up again and remove the flexibility or close that window for India. And a rollover in growth in the US, which is a possibility for 2016, could close that window of opportunity for Janet Yellen.
Before we move forward, here's a look at my exclusive conversation with Sanjeev Sanyal of Deutsche Bank, who's of the view that in the short term, the volatility in global markets is here to stay. But Indian markets clearly have a large scope now, as global capital could once again move back to India.
There's no question that the momentum in the world, whether or not in the US, but certainly for the world, is really not gathering steam. So I think it is not that surprising that the Fed has decided to put things on hold. It's possible that they will go and begin to hike rates later in the year, but I think it's fair to say that that cycle will not be very aggressive. And as I have argued for many years, as you know, that even if the Fed did begin to tighten, there is so much cheap capital being pumped out by China, and will be for the next several years, that the global cost of capital is unlikely to rise for a long time to come. So even if the Fed was tightening, I don't think it would have made so much difference for the price of capital on this planet.
The current administration has taken a lot of small measures. Some of them are on paper great measures as well. Increase in public spending. They are looking at a new auction in place for natural resources. Do you think these small steps, which are not reflecting in the absolute number, would eventually show up?
Well, if you're going to take small steps, then you have to keep taking small steps continuously. So I think the auctioning, by the way, that I think is a fairly big step potentially, if it's sustained and shown to work. It certainly brings down corruption. It's also much more efficient. But there are other steps where, like GST and land acquisition, where things have got stalled. That's okay. As long as continuously steps are taken to move forward, I think that's good. The cumulative effect will eventually show through. But I think there is a lot more that can be done, even with, say, the upper house of the parliament stalling the big measures. I have argued for some time that there are many administrative measures that can be done. There are many reforms that can be done on the fiscal side. These are money bills that can be passed through the lower house that can be done, and so on. Many things can, of course, be done at the states as well. So I don't think it's entirely an excuse to say that the parliament is stalled and therefore the big measures are not going through.
India Inc. is also equally excited. I also spoke to a whole host of India Inc. representatives, and frankly, they are not really worried about the economic slowdown.
Investors outside India they have much more faith and interest in our country than we seem to have within the country itself. We are very critical of ourselves. There was a huge amount of credit offtake on account of number of huge projects coming. So unless those projects come back again, you will not have that kind of comparable credit growth. We are now sensing that the projects are being discussed. Some of the proposals are coming to us. So we believe it is something that will happen in the next 2 to 3 quarters. But definitely by the end of this fiscal year, I think we will definitely see some movement. I think at 25 basis points, definitely there is a case for it.
Our expectations from the developed world are low, and our expectations of the developing world are high. And against those benchmarks, I guess we feel that the developed world is kind of overperforming a little bit, and we feel the developing world is underperforming. But look at it this way. China is still growing. India, you heard the finance minister say, growing at 7% plus. So it's not that you're not getting growth, barring maybe a Brazil. You have actually growth still taking place in the developing world. India is a great story in the medium to long term. It has all the makings of becoming an economic powerhouse. No question about it. We have a strong entrepreneurial base. We have enormous talent in the country, resources. The monetary policy is under control. Our fiscal deficit is low. So I really feel good. I think what we need to do is to make sure that we have an ease of doing business, and we do some really tangible steps to lift the skills base of India.
I'm confident now that India will be the standout country in the world, of course, besides the United States. So if you look at all the emerging countries, they're going through a very challenging situation. Europe is going through also difficulties. And India, in that sense, because of its inherent strong domestic demand, because it was so much dependent on actually commodities and which prices are going down. So it's a good time for India. There is an issue of land. I hope that we'll get some resolution on land. Taxes, we are hopeful that there's more and more clarity. The fact that there's no retrospective taxation itself is positive. We definitely need to now see that there should be in the downward trend. I think that again, if that goes, I believe the sentiment will improve significantly because of this, and you'll see capital investments taking place.
There is a plan, very well thought of plan, which Indian government is going ahead with, and there is surely a opportunity to invest in India and take part in the growth of Indian economy. Now, to re-change that engine to fast-moving engine, it requires time. It has its own inertia, so it requires a lot of effort and consistent perseverance by the government in terms of investment to economy to kickstart. And I think we will see that's what is going to happen. Obviously, when the demand levels were low, there is no requirement for additional manufacturing, so that manufacturing doesn't happen. When it comes to infrastructure, yes, infrastructure investments have suffered because of the past legacy, and I'm sure as the things get resolved, infrastructure will also get investment from private sector. Government's investment in infrastructure is what is going to actually generate demand. And once this demand picks up, I'm clearly seeing that there will be investment done by private sector, because then there will be consumer demand, and for consumer demand we will need to produce more. As far as pharmaceutical is concerned, we see double-digit growth, 13-14% on Indian pharmaceutical market, and the global demand even in fact is going up faster. The markets are growing, but also more we are actually taking market share from competition in the global market. So Indian pharma industry is seeing a growth of about 18 to 20%, and I think that will continue.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.